Right now is one of the craziest times to invest in Canadian resources. We've seen a giant super cycle of investment into things like new oil and gas industries, new mineral industries, new export, new infrastructure. Canadian resources are absolutely one of the best opportunities that we as Canadian investors have right now. One of the biggest industries that's seeing huge investment is Canadian natural gas. Today, we're going to talk about a company called ARC Resources and how they've been tangled into the web of what is being called the biggest deal in the oil patch in a decade, where Strathcona Resources went out to try to buy MEG and just unwound a huge number of deals, including, crucially, some big sales to ARC Resources, accelerating ARC's growth and making ARC potentially even better for many investors looking to get into this natural gas boom. Welcome to Golden March Investing. My name is Liam. Here on the channel, we talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. We've talked about ARC Resources fairly recently on the channel, where we talked about their strategy and how their specific way of going about the natural gas industry presented great asymmetric return, meaning they had huge upside potential thanks to their exposure to natural gas, their exposure to the change in AECO natural gas pricing in Canada, and of course, crucially, their exposure to the growing LNG industry in Canada, where we ship off natural gas at a great price, much higher than the current North American price, and we seem to be expanding this LNG industry every single year. There's more and more projects coming online. LNG-Canada is coming online this year. It's just a fantastic opportunity, great upside. And they also have the protection to the downside from their condensates business, where they produce an absolutely crucial component of the oil sands business of every crude oil producer in Canada, which basically means they have a stable floor and a great upside. Asymmetric return, if you will. Now, of course, in that video, we covered all sorts of great details, but today, I want to talk about how the resources that they acquired from Strathcona can accelerate the growth in their business and potentially make this upside even more attractive. And of course, to do that, we're going to break down some really interesting key details that have been put out there by some analysts. One of the best places we've found these articles over the last couple months here is on Seeking Alpha. Our article today is from Long Player. It is somebody who talks a lot about the Canadian oil and gas industry and who absolutely does have great sources in the industry. They know what they're talking about and they help break things down for us. And of course, we're talking about the accelerating growth of ARC Resources thanks to this acquisition. And they cover a couple of the key things that we've talked about already here on the channel, specifically condensate being in short supply, being a premium asset right now. And of course, talking about the numbers. The new assets are boosting production by 40,000 BOE or barrels of oil equivalent per day with a highly desirable 50% liquids mix, including 11,000 BBL per day of condensate. The Attachie phase 1 project they're doing right now is also increasing production. So there's a huge amount of production increasing. They talk about ARC Resources, their first quarter. We've talked about this recently. They get a good first quarter. So did a lot of natural gas producers. We talked about the Birchcliff model probably 2 months ago here on the channel, where that company saw a huge spike in stock price, a big jump, because they suddenly showed off the increased pricing power they had this year, thanks to LNG-Canada contracts. Now, ARC Resources didn't quite have the same jump, maybe, but it definitely has had a pretty good couple months. We've seen significant growth over the last little while. We have seen definitely stronger pricing over the last month than we saw in crude oil. And we've seen it kind of, accelerate a little bit over, let's say, the beginning of May through to this section of May, as a lot of the market has seen their V-shaped recovery. And while we've seen some faltering at the start of June, I would expect that to continue. Canada often has to import condensate to meet its needs, which obviously is a key reason why producing it here is a premium asset, right? Obviously, you don't have to then pay to transport it so far, and is a big part of ARC's downside protection. Now, the acquisition here, the proposal is to acquire acreage that is right next to an operated acreage. So the properties are right beside each other. Such acreage is generally more valuable to an operator like this because of the combined, largely contiguous acreage often offers opportunities to save cost compared to a lot of scattered properties. I don't think that's hardly rocket science, right? If you can have everything put together, then everything can run a little bit more cheaply than if you're going to spread it out over thousands of miles of wilderness. That's obvious. And I think it's been a big part of a lot of the strategies in the Canadian oil and gas industry over the last 10 years. We're trying to cut costs. How do you do that? You consolidate. If one player runs one thing, they can do it cheaper than if everybody runs a little bit of everything. As shown above, it'd be hard to ask for a better fit to the existing operated properties. Obviously, you can see on the little diagram we have here, blue is their current properties, green is the acquired assets. They're pretty close in with each other. According to their press release, directly adjacent, they're going to add 40,000 BOE per day. We talked about this in the summary earlier. 50-50 between crude oil / liquids and natural gas, and 11,000 barrels per day of condensate. Desirable production mix, the acreage cost is 1.6 billion combined with 20 million for some unrelated equipment, basically to use the acreage. And this will be financed with debt, but the debt ratio will still be below 1.0 at 0.8. Knowing this management, they will likely get that debt ratio down. But for just about any other company, that's about satisfactory. That is pretty good. In the oil industry, I'll say this right now, depending on the specific times, things might change. But in the oil industry, considering the way things go, you typically don't get rid of all of your debt. I'll see this. A lot of these companies will operate with debt for a long time because there are advantages to having that debt on the balance sheet for these companies. So you're likely to see them increase returns to shareholders before they actually pay off all the debt. And if you were a beginning investor or an investor from another industry, you might look at that and be like, whoa, why are these guys holding so much debt on the balance sheet while they have these crazy free cash flows and they're paying out so much in shareholder return? Why would you want to do these two things at the same time? Wouldn't it make more sense to pay down all of the debt? Well, no. As long as you can keep the debt under a certain ratio and maybe not 100% debt to equity, right? Or 1.0 debt to free cash flow. That maybe not those kind of ratios. But if you can keep it low enough that you can comfortably pay it off if ever the situation changes, then it makes sense to hold it for tax reasons. And it's just a more efficient strategy. And it seems to be the default strategy for Canadian producers. Now, it's not the same strategy for everyone, but a lot of them have sort of followed that strategy. And then at a certain point, you get your debt low enough. Well, now you can also make acquisitions like this one, keep your debt low enough, and continue your shareholder returns. Usually the acquisition is going to sort of eat into a little bit of that shareholder return because you can assume, okay, if they had this money to spend, they could have spent it on a special dividend or a big buyback program or something versus buying this. But if they think, hey, okay, buying this property at the price it was offered to them, which remember, Strathcona was looking for money quick. So the price was probably not a giant premium. Buying this property for them probably represented a better return than just giving the money back to the shareholders. They think that they can actually sort of leverage this property and continue to grow and continue to expand and continue to cash flow. And in the long run, that'll benefit shareholders more than if they just spent that $1.6 billion on a shareholder return of some type. And in most cases, I would agree with them. In natural gas right now, there is opportunity to expand. Now, different companies are taking it different directions. I will say we've talked about Tourmaline. They're the biggest Canadian natural gas producer, and they're sort of gung-ho on the expansion front. They have, I think it was 25,000 prepared wells ready to be going as soon as LNG-Canada is online because they see, hey, price goes up, all of a sudden it makes a lot more sense to produce more. It's the constant story, supply and demand in any commodity like this. These guys obviously also see some opportunity to expand. Now, that's sort of, maybe they're taking more middle ground. Maybe this is just like an opportunity came across the board. But there are definitely others that are like, whoa, pump the brakes. We're going to return money to shareholders. We're going to, bring down our costs even more. We're just going to chill. And maybe that's a little bit closer to the pay-dough method. They're growing, I think they were saying like high single, low double digits, right? That's kind of the area they're looking at for the next little while. And so everybody's taking a different approach to this. But maybe this opportunity was just way too good to pass on. And because it was there right beside their existing assets, it made the most sense for them to buy versus somebody else coming in buying that. And again, you have the problem of being like, oh, I have this asset way over here that I have to operate, but my team's over here at this other asset. And that's a huge pain and it costs a bunch of money. And you have to have guys driving there, or you have to have a whole new team there, maybe new managers, new buildings, right? There's all sorts of extra money that goes into that. So this maybe makes a lot of sense for them in contrast with what they could have done with the money. And having that debt is probably not as stressful as it would be in a lot of other styles of companies. If it was at a retailer or if it was at a tech company or some sort of small cap startup, yeah, okay, I wouldn't love that debt ratio. But in a resource producing company like this, it does make sense. Good news for ARC Resource shareholders is that production will immediately add to company's profitability and free cash flow. That is good news. We like to see when these things are immediately accretive, so they immediately pay off. This is an unexpected boost to profits exceeding guidance for the fiscal year. As a result, investors can now expect new guidance when the company reports the second quarter. And you could see a pop on that. It depends how excited they are about that. New guidance events can usually sort of dictate the story behind a company like this for the following year, let's say. So if they give new fiscal 25 till the end of this year, well, I would expect that to be sort of the guiding document for how the market views this company in the year. And of course, analysts then can come out and maybe rate the company or change their rating or whatever. And that could then sort of steal the attention. But usually when we look to that, we would see, again, when is Q2 earnings going to come out? Yeah. Sometime in the summer here. We could likely see a big sort of narrative played out for the next 6 months, sort of the end of the year, maybe even into next year, because fiscal 26 guidance may not come out until, let's say, January, or maybe it's at the December meeting. So depending, this could be the story for the next little while. And if we see them optimistic, if we see them say, hey, we can capture this extra premium because LNG-Canada is online and we expect AECO prices up. I think the sort of default street expectation was like $1. So they would increase by about $1, and that would cut the differential to about $1.75 between AECO, the Canadian natural gas price, and Henry Hub or US natural gas price. We will definitely see. Earnings. Free cash flow took a big jump thanks to rising natural gas prices from the unusually cold winter. We see that here. Let's look at some examples. Okay. If you look down here, free funds flow, $399 March 31st, 2021. They're at 102 in March 31st, 2024. So that's huge. Net income obviously looks great as well. Cash flow from operations looks great. It looks good across the board. Since the acquisition was made from debt and the debt ratio is still well within the acceptable range, and we talked about what that range kind of looks like, companies likely to outperform most natural gas producers thanks to that acquisition. Likely. That doesn't mean there can't be more acquisition. This has been a crazy year for M&A in the Canadian oil and gas space, so we could see somebody else top this within the next 6-10 months. We'll see. Any seasonal fall off in natural gas price, which usually happens in the spring, summer when people don't have to heat their homes, but in the shoulder season before it gets way too hot. Now, I will say, I'm speaking for Western Canada here, not for Eastern Canada. It's been hot. We've had some 30-degree days here already, which is very unusual. And of course, it is incredibly unpleasant right now thanks to all the wildfire smoke, which is not lovely in a lot of Western Canada. If we see it continue to be dry and hot, maybe that is sort of more natural gas demand. Now, I would prefer, this is just completely personal opinion, I would way prefer it to start raining all across the West right now. Cool down, start raining, because that is definitely beneficial for all of us. As Canadians, we want these wildfires out. But it has been hot. So maybe the seasonal fall off isn't going to be that bad, but the seasonal fall off is also going to be offset by this increased production. And since production is up about 10% without any additional shares outstanding, that means that sort of earnings per share numbers are going to look slightly different. The company has been repurchasing shares for some time. A long-term plan was to reacquire all the additional shares issued for an acquisition made some years back. From time to time, management provides a slide on how that plan is going. The low debt ratio may allow debt repayments as well as share repurchases going forward. So if you think about it, okay, once upon a time they used shares to buy another asset. This time they use debt. They could structure that sort of repayment to then, okay, some money goes towards that debt, some money goes towards the shares outstanding. Each has its pros and cons depending on where the situation is at and what you're projecting in the future and what the interest rate you're paying for that debt is and all sorts of complicated stuff. But that would make sense, right? To have a plan where, okay, not only now are we talking openly with shareholders about how we're repurchasing the shares from this earlier acquisition using presumably the free cash flow from that acquisition, but now we're also going to use some of the free cash flow from this acquisition to then pay down the debt that we used to make this acquisition. You see where I'm going with this. Currently, the plan is to distribute to shareholders all free cash flow. We will have to see how that is carried out in the future. Again, these companies don't usually pay off all their debt, but this might be an exception. Maybe they don't love where they're at right now. We'll see. We'll have to see. Again, that guidance document coming out in Q2 is going to be the guiding direction because it'll tell us where are they going with this? What do they see happening? What kind of realized prices do they expect? All sorts of interesting stuff. Usually the execution of the plan involves a combination of stock purchases and dividends. Yep, that should continue. Note that this company is in the unusual position of having free cash flow that nearly equals the earnings. This is an extremely high level of free cash flow. Then we talk about Attachie. They have a significant production growth from the startup of the Attachie project, which is starting up this year. And it's in the Montney here. They have 300 net sections in condensate-rich Montney overpressure liquids-rich resource. They have a multi-layer development which leverages Montney data and experience to maximize efficiencies. And phase 1 has been executed safely and on time. Full development plan is in place, including takeaway secured for phase 2, and they have First Nations support. So this like gives an example of what their well looks like and the different levels that they're at and the different levels that they get at each level, and all the things going on. And it shows you some of the pipes going through and the historical wells, the phase 1 setup, the phase 2 setup area. It shows that they're selling liquids up to Pembina. They're selling gas to TCPL and West Coast. So very detailed map of exactly what's going on there. And it looks like that worked out well, and maybe they'll get phase 2 going in the not so distant future. The plan to bring Attachie online will be completed in the current fiscal year. Management also plans to start the process of planning the second project, like we just said, to expand production. Some parts of this process have already been completed. You see all going on there. 2025 production averaged 31,085 barrels of oil equivalent per day. 14.8 thousand was condensate. H2, so second half 25 production on track to average 35,000 to 40,000 BOE per day, following partial downtime at the facility in March and April. As with any startup, there will be bugs that need to be dealt with. Yep. You should never expect a project to go perfectly. That's something I should say for LNG-Canada. We're talking about LNG-Canada coming online this month, theoretically. We're halfway through the year, right? Maybe next month. It could be a little bit later. But I think, the expectation is huge because the long-term implication is huge. But there could be short-term downsides, and I don't think you should panic at them, right? With the exception of some sort of disaster, which let's not wish into the world. We should expect to see, okay, maybe some things go one way, some things go another. There's slight problems, there's some downtime, and that's annoying, and companies get grumpy, and it makes a good news story, particularly for people who want to sort of argue against the further investment in this industry. Right? You could see that. Don't overreact to that. That's not going to change the whole story unless it's something that's like significant life-changing alterations to LNG-Canada, in which case, of course, we'll talk about it here. We'll talk about what that means for the industry. All right. So we talked about, anyways, bugs are a problem. Interesting, the liquids part of the production is exceeding the company average for production mix. That means more cash sooner for the company with likely gassier production later. And that has to do with the geology that they're drilling, right? Because typically you get the liquid or the gas, and if they're getting a lot of liquid now, they're expected to get more gas later. Last time we talked about this, they noted that the startup of the Attachie project assured an unusually significant growth year. Latest acquisition has added to the significance of the growth spurt in the current year. So this year, we saw that. We looked at the earnings, right? We're talking significant amounts more money right now coming into this company, both in earnings, but also in the crucial free cash flow, which is something that energy investors love to look at. Resource investors love to look at. That's a great way to look at a company sort of just on a really quite equal basis. If you look across companies, free cash flow is probably the easiest thing to look at. When we see significantly increased free cash flows, that's great. And there is now going to be increases thanks to Attachie and increases thanks to their cacao acquisition from Strathcona. So to summarize, ARC Resources is an investment grade idea where management looks for growth products that move the needle. Normally, companies this large grow in the single-digit range, if that. Management generally keeps long-term production growth in the 10% or slightly higher range. However, many times, as in the case this year, that growth comes in lumps. So that makes this company a fairly attractive, strong buy growth and income idea. Current yield may be a little bit lower than some would prefer, but it grows at a good pace because management is growing the business. As with any upstream operation, a dividend has to be looked at as a variable dividend because of the dependence on commodity pricing. Huge. Don't use commodity dividends to fund your lifestyle. Please. We have talked on this channel lots about dividend investing, dividend income investing, right? And I personally, I'm a younger person. I'm just sort of in my career here. I'm not investing to retire anytime soon. I've got a 10, 15 year time frame. That's what I look at. That's why dividend growth makes sense to me. A company that's growing and paying out an increasingly growing dividend, where I can take that dividend, reinvest it, and continue to grow that dividend snowball. That's what I'm looking for. If you are looking at 5, 10 years or shorter, and you need to be able to rely on that dividend, there are maybe safer, less variable assets that you could be buying into. be it preferreds or even like more blue chip. I hate the term blue chip, I gotta say, but maybe more stable business models. Banks, grocery stores, pipelines, even if you want to be in the oil and gas space, pipelines. These all have maybe more stable dividends because they have more stable businesses. Things don't grow as fast. Sure, they don't have the potential for that great upside, but they also are more stable. And if you're going to depend on that money to live, you want it to be more stable. However, this company is in an unusually profitable situation because it has a large percentage of condensate production and production mix, which again gives them a huge advantage. While next year may feature relatively flat production or definitely slower growth, planning for the startup of the next phase of Attachie project promises still more growth in the future. Management like the one here could reward the investors handsomely over the long run from the current price. The risks involve the dependence on condensate. One of the key markets for that oil is the United States, and they're saying that there's going to be if the US completely decouples their economy from ours, that is really bad for ARC. It's really bad for all of us, let's be honest. Also, there's all sorts of other things, volatile commodity prices, loss of especially talented individuals, and all sorts of stuff like that. I love when articles like this that are really, really bullish also include the risks at the end, because that's an important thing to leave with. So let me leave you guys with some of my thoughts here. What do I think the story is? I think there are maybe two stories here. One, from the sort of bird's eye perspective, looking at the industry, it looks like Strathcona was ready to make a move, needed to sell something, and said, hey, ARC, this is the most valuable to you. So here, this is the price we can get for it. It doesn't seem like ARC paid up a huge amount for this asset. We didn't see the sort of headlines talking about the valuation of this asset the way we did when Strathcona went over to buy Meg, and that, that acquisition and the price they were offering, and the right, oh, how much is this going to be worth? That made headlines, and this did not. Partially because it was overshadowed, yes, but also probably because ARC was the most likely to buy this thanks to the scale of the whole thing. It's a $1.6 billion acquisition. That is not peanuts, but in the world of some of these big acquisitions, that's not gigantic either. And we've been talking about $10 billion acquisitions in the last little bit. So single digit billions, big, but it made more sense for a fellow Canadian producer in that region that actually has the synergies to make that worthwhile. So it looked like the acquisition they got was a good price from a sort of bird's eye view perspective. And it makes sense in this sort of narrative of the industry. There's also, of course, now the question of maybe ARC getting bought or somebody offering to buy ARC, I should say. The Meg deal obviously is a hostile takeover, as in Meg didn't invite them in to buy them. And while there are differing opinions for sure, I think it's really interesting to see, is somebody going to come along and look at ARC, maybe a supranational like Exxon like size company, a really big company, or even like a Canadian giant, right? Maybe Canadian Natural, pardon me, is going to look at these guys and say, hey, great business. What if we owned it? Now, no guarantees that happens, but from a bird's eye view, this acquisition looks good. And now there's great potential for ARC. From the perspective of ARC itself, it looks like this is going to be immediately accretive. This year is a huge growth opportunity. We have seen some growth in the stock price, but not huge. We did not see a giant pop on this news, which means investors aren't certain yet. I think the more you see trade deals work themselves out, the more you see the price of oil stabilize. We've seen that trend playing out recently. The better the stock price gets. And so there's an opportunity now where there's still some question marks in the air. And before that Q2 document comes out that guides the next 6-10 months, whatever it might be, but really guides the direction of this company, there's going to be an opportunity where this company is probably in no man's land. And then you see the company offer that guidance, and then suddenly you're going to see analyst ratings come out. They're going to update their ratings because the guidance is different. You're going to see maybe big purchases, right? It could be like pension funds or other big investors could make some moves here, buy in a little bit, and then we'll see the direction. And I believe, based on every bit of information I have available to me, that direction will be up. And I think you can expect to see that direction maintain for as long as the LNG super cycle maintains, for as long as this large bull run continues. And I've seen big investors, guys who are really knowledgeable in this space, say that this could be like a multi-year trend. This could be 2 to 5 years of positive catalysts for Canadian LNG. Be it the decrease in US production, be it the increase in Canadian infrastructure, whatever it might be, it looks good for Canadian LNG for the next 2 to 5 years. And I think this company makes a lot of sense in that space, thanks to the asymmetric return opportunity we've talked about before. Those are just my opinions, of course. And I strongly recommend you check this company out. If you're looking for an investment in this space, if you're looking for LNG, there are lots of opportunities. There are lots of great Canadian LNG companies, but this should be on the list. And that's about all I have for you folks today. I hope you enjoyed that video. If you did, please do like the video, subscribe to the channel. Let me know in the comments down below, who would you like us to talk about next? Any specific companies, any specific industries? Love to hear your thoughts in the comments. And if you wouldn't mind subscribing to the channel, makes a huge difference. I hope I see you in the next one.